I'm Alan Kenny, Editorial Director with REIT.com, and we're in New York for REITWeek 2014, NAREIT's Investor Forum at the Waldorf Astoria Hotel. Joining me is Daniel Hurwitz, CEO of DDR. So, Dan, I know that DDR has done quite a bit of work to kind of refine its portfolio, including exiting Brazil. Can you give us an idea, how far along are you and what the ideal portfolio will look like for DDR?
Well, we've come a long way. In the last 4 or 5 years, we've sold about $4 billion worth of assets, but we've also purchased about $4 billion worth of assets. So we've had a very aggressive capital recycling program that has resulted in a high-quality portfolio of power centers, high credit quality of cash flow, very low accounts receivable, and very high lease rate and very high same-store NOI growth. All of that is a conscious effort that we have to focus on quality, because that was an issue that wasn't focused on in the past, and something that we needed to refine within our context of our strategic plan. So quality is very important to us. We'll continue to do that. Brazil was a great investment for us. It was time to leave, and part of having a great investment is knowing when to get in and when to get out. And we thought it was the appropriate time to get out of Brazil. It complicated the story. It represented roughly 4% of our NOI and about 75% of the questions that we got from investors. So we thought this was the right time to get out, because number one, we could get out at a significant profit, and number two, it added to our goal to simplify our story for investors.
And looking at the retail space, how prevalent is new development? Is that driving growth?
Well, there is some new development in some sectors of the retail space. In ours, which are the large market dominant power centers, there's almost none. One of the things that's driving our rental growth, one of the things that's driving our occupancy gains, is the fact that there is no new competition right now in the market, and there is none in the foreseeable future. So what you own is worth more. As tenant demand continues to increase, supply continues to dwindle, and it's a very friendly landlord environment in that regard.
Now, you just mentioned tenant demand increasing. What's driving that?
Market share gains. The tenants that we predominantly do business with, the tenants that sell branded goods off price, people that are trading not necessarily cheap, but value, giving the consumer value, are winning the market share game on a consistent basis. And as a result, they're looking to do more and more stores, with less and less being available through new construction. Obviously, that leaves your portfolio, our portfolio, more valuable to those tenants. So the tenants that are winning the market share game are the tenants that are growing the fastest, and appropriately so.
Dan, thanks so much for your time.
Thank you very much, Alan.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.